Hello, good afternoon, and welcome to this NQA presentation, ISO 27001 Risk Assessments Explained. I'm your host, Chris Smith. I'm the Principal Information Security Assessor at NQA. Just before we get going, just a few housekeeping bits. If everyone can hear me okay, if someone could just put something in the questions box just to tell me that I'm coming through loud and clear. That's great. Thanks guys. Thanks very much. Also as well, if you've got any questions, there will be a Q&A session at the end of this webinar. So if you've got any questions, please feel free to keep them till the end, and we'll try and answer as many as we can. As with all webinars, if there's any questions we can't get around to answering during a webinar, we will put together a frequently asked questions blog, which will appear on our website in the next few weeks. So a little bit about NQA then. We're obviously a global company, offices in Boston, London, Bangalore, Shanghai. We've been in operation for 30 years. We operate in over 32 countries, and we've so far issued over 36,000 certificates globally. There's a few bits about the clients that we work with and also our price promise as well. You will get a copy of these slides once the presentation is finished, so you can read through these at your leisure. So what are we here for today then? Well, we're going to look at all the things in the topic there. So we're going to look at information security risk management methodology. Now these are the rules for conducting a risk assessment. Now these are your rules. The rules within your business, which obviously can differ from industry to industry and sector to sector, but they're relevant to you and your business. We'll also look at the identification of information security risks. So what kind of things are threats, or what can be classed as threats? Then we're going to look at performing information security risk assessments themselves. So what to consider when performing your risk assessments. We'll look at the treatment of information security risks, what to do to control the risks, and there's 4 options available that we'll be looking at. However, how you treat the risk is entirely up to yourself, again, based on your industry or sector, and also the sensitive nature of the risk. And then we'll also look at reporting, how to report on a risk to avoid the risk being overlooked or deemed too complicated. So, for those of you new to 27001, a little bit of an introduction to the standard. Now, 27001 formally specifies an Information Security Management System, or ISMS. Now, this is a suite of activities concerning the management of information risks called Information Security Risks in the standard. Now, the ISMS is an overarching management framework through which the organisation identifies, analyses and addresses its information risks. The ISMS ensures that the security arrangements are fine-tuned to keep pace with changes to the security threats, the vulnerabilities and business impacts, which are an important aspect in such a dynamic field and a key advantage of 27001's flexible risk-driven approach. Now, the standard covers all types of organisations such as commercial enterprises, government agencies, non-profits, all sizes from micro businesses to huge multinationals, and all industries or markets such as retail, banking, defence, healthcare, education and government. And it's clearly a very wide brief. And also, it's not just about IT. A lot of people think that 27001 information security, it's all about IT. It's not. It heavily leans on IT, but it's not an IT standard. It is a standard that fits across organisations. Now, 27001 is an information security standard, to be said, and it helps companies come into compliance with international best practice models. The standard covers 3 key components of data security: people, processes, and technology. Now, when steps are taken to safeguard data with these 3 components in mind, businesses are better equipped to protect information, mitigate risks, and also rectify procedures that are deemed ineffective. As such, a growing consensus has emerged in the corporate sector that deems 27001 to be the gold standard in best practice schemes. Now, by putting 27001 standard into effect, an organisation activates an information security management system, an ISMS, which works within the business culture of the company in question. And the standard is regularly updated and enhanced. And these ongoing improvements allow the ISMS to stay abreast of changes both within and outside of the company, all the while spotting and eliminating new risks. Now, it's designed to support the confidentiality, integrity, and availability of your information, and also help you maintain legal compliance. It helps you to protect your data from cybercrimes, misuse, fire, theft, and other threats, which we'll go into in more detail a bit later on. Now, having a certified ISMS in place will give your customers more confidence in your company, as well as improve your relationships with other stakeholders and allow you to mitigate risks. Now, if we look at the three topics there: confidentiality, integrity, and availability. A common example of confidentiality would be, for example, an online transaction conducted over secure methods, such as the use of encryption, whereby information is protected via HTTPS or passwords or something like that. Or, as it says there, ensuring that information is not made available or disclosed to unauthorized individuals, entities, or processes. As for integrity, an example would be the trustworthiness of customer financial account information, i.e. bank accounts, personal information, which is held by a bank for conducting daily operational transactions. So that's safeguarding the accuracy and completeness of assets. So you want your information, whenever it's held, to be accurate, to be up to date. As for availability, and this could relate to a bank's customer-facing web servers that host the online banking portal, for which customers can access any time of the day. And as it says there, availability means being accessible and usable upon demand by an authorized entity. And this has been quite a hot topic recently, with some of the major banks losing their online banking facility, which has caused no manner of problems for customers. So let's look at a few definitions then. And these definitions they're according to ISO 27000, which is the Information Technology Security Techniques and ISMS overview and vocabulary. So we got the first one there, information security. This is a preservation of confidentiality, integrity, and availability of information, which we've just discussed. We've also got risk, which is this is common amongst most standards and most business practices. It's the effect of uncertainty on objectives. Then we move on to risk assessment, and 27000 describes risk assessment as the overall process of risk identification, risk analysis, and also risk evaluation. That moves us on to risk treatment, which is described as a process to modify risk, and lastly risk acceptance, which is an informed decision to take a particular risk. Now, key things here that we're going to take more of a look at in this webinar is risk assessment and risk treatment. And the assessment and management of information security risk is at the core of 27001. Now, firstly, you've got to come up with a risk methodology. So what is it? Now, this is the first step on your voyage through risk management. You need to define rules on how you're going to perform the risk management, because you want your whole organization to do it the same way. Now, the biggest problem with the risk assessment happens if different parts of the organization perform in a different way. You want everyone singing off the same hymn sheet, basically. Now, therefore, you need to define whether you want qualitative or quantitative risk assessments, which scales you will use for qualitative assessment, what will be acceptable level of risk, etc. So this is your criteria. How are we going to do this? Okay. Then you need to adopt a scale. For example, this could be in monetary terms, simple numbers, or even low, medium, or high. We will talk about qualitative and quantitative risk assessments later in this presentation. Then you decide on your appetite. So once you've determined your risk, you need to ascertain how important that risk is to your business. How big of a risk is it? Okay, is it a medium risk? Is it a low risk? Is it a high risk? And you need to think about the assets or the scenarios. So when performing a risk assessment, think about the items you could have under your control and the potential situations that may arise which could cause a risk. What's the threat or the vulnerability to that asset, and in what scenario could that arise? Now, these are the rules governing how you intend to identify risk, who you assign risk ownership to, how the risks affect the confidentiality, integrity, and availability of the information, and also the method of calculating the estimated damage of each scenario and the likelihood of it occurring. So we've got our criteria, we've got our rules for how we're going to conduct a risk assessment. So what about identifying the risks? Well, identifying the risks that can affect the confidentiality, integrity, and availability of information is the most time-consuming part of the risk assessment process. Now, following an asset-based approach can help developing a list of information assets is a good place to start. But if you can find an existing list, most of the work will be done. You have to analyze a risk. So you must identify the threats and vulnerabilities that apply to each asset. For example, if the threat is, let's say, theft of mobile device, the vulnerability could be, well, a lack of formal policy for mobile devices. After you've done this, you should assign impact and likelihood values based on your risk criteria. You could use severity instead of impact, for example, or probability instead of likelihood. Again, this is your risk assessment. This webinar is just a guide. It's not, these aren't set down laws to say this is how you should do it. This is a guide to give you an idea of how risk assessments can be applied. Now, once you know the rules, you can start finding out which potential problems could happen to you. Now, you need to list all your assets. As we said, this may take a bit of time. Then you need to list all the threats and all the vulnerabilities related to those assets. Assess the impact and likelihood for each combination of asset, threat, and vulnerability, and finally calculate the level of risk. Now, in my experience, a lot of companies are usually aware of about 30% of their risks. Therefore, you'll probably find that this kind of exercise is quite revealing. When you are finished, you'll start to appreciate the effort you've made as well. As we can see there, I've put an example up there of asset, threat, and vulnerability. So assets can be anything from infrastructure, organization, some of the processes, some of the applications you have. The threat, obviously, if it's an IT asset, it could be from theft, could be from accidental damage or malicious attempts to steal it, malfunction. And then the vulnerability, well, if it's the theft, it could be determined as an unattended device. So, for example, this is one I've just put together. One asset may have numerous threats and vulnerabilities. So if we look here now, we've got a laptop, for example. So a laptop may have numerous threats. So as you can see there, a laptop, the asset of a laptop has got two threats there, theft and malfunction. Now from these two threats, we could have numerous vulnerabilities. So as you can see there, from theft, we have, well, the vulnerability of theft is an unattended device or unsecure premises. From malfunction, we've got poor maintenance or software not updated. So you can see there, when you've made your asset list of laptops, desktops, whatever you've got, you then think about the threats. Well, you can have numerous threats for one asset, but then even more vulnerabilities for all those threats. Now you need to weigh each risk against your predetermined levels of acceptable risk, i.e. your risk appetite, and determine which risks you need to address and which ones you can ignore. Now, as you can see on the screen, this is the most common example I see out and about auditing, and others are available. You know, you can have a 3x3 matrix, a 10x10 matrix. I've seen numerous ways of doing it. Again, how you conduct your risk assessment is entirely up to you. You've got to make it fit your organization. So in this example, we can see that we've got a 5x5 matrix. We've got impact up the side and likelihood down the bottom. So up the side, we've got if this risk happens, if this threat materializes, what is the impact to the business? And then along the bottom, we've got, right, what is the chance of this happening? So, for example, if we've got the previous example of the laptop being stolen, we could say, well, the impact of that being stolen is a 3, for example. What are the chances of that happening? What's the likelihood that's going to happen? Well, we'll give it a 3 as well, a medium. So we can see 3x3, 9. So that gives us an overall risk rating of 9, a medium, if you say by the key. Now, from here, you can determine the overall risk rating, high, medium, or low, as you said. And again, the numbers you use, the criteria you use is entirely up to yourself. This is just a guide. Now, impact is usually measured in terms of confidentiality, integrity, and availability, as you can see on the screen, and may include financial, reputational, and regulatory impact, also information security and operational impacts. Once you've analysed your risks, you need to evaluate them to establish where they fit in terms of your risk appetite. Only once you've done this can you decide the appropriate way to treat each risk. Now, this means you should be able to quickly identify your highest risk and create a prioritised list of which risks need to be addressed in what order. And it's particularly important to identify whether or not the risk falls within or outside your predetermined level of acceptable risk. When risk owners say they will not accept a risk of, for example, 9, let's say, now they must be prepared to accept a business situation. So, for example, such as a loss of £100,000 every year if we accept that risk. Now, rather than the less relevant impact of 3, likelihood of 3. Okay. In practice, there is a link between impact and threat, and vulnerability and likelihood. As similar threats tend to produce impacts on business, and similar vulnerabilities produce similar likelihoods. Impact types could include, for example, human, financial, legal, regulatory, reputational, and operational. Likelihood factors could include frequency of occurrence, previous occurrence, current levels of security controls, size of attack group, and knowledge of vulnerability. So, conducting a risk assessment then, and we spoke about quantitative and qualitative earlier. So, quantitative risk assessment and methodologies give quantitative estimates of risk, given the parameters defining them. Now, they are used in the financial sector, the chemical process industry, and other areas, for example. Now, in financial terms, quantitative risk assessments include a calculation of the single loss expectancy of monetary value of an asset. So, as you can see in the example there, one of the examples I've used as risk there is the office flooding. Now, if the office flooded, we could say, well, it's going to cost us £10,000 to repair that. Now, flooding occurs every 2 years. So, from previous times that flooding occurs every 2 years. So, an annual expected loss could be £5,000, for example. So, there's your quantitative risk assessment of the office flooding, £5,000 annually. Now, qualitative risk analysis is a project management technique concerned with discovering the probability of a risk event occurring and the impact the risk will have if it does occur. All risks have both probability and impact. Probability is a likelihood that a risk event will occur, and impact is the significance of the consequences of that risk event. Now, assigning probability and impacts to risk is a subjective exercise. Some of this subjectivity can be eliminated by developing rating scales that are agreed upon by the organisation. Generally speaking, an organisation must define impact and likelihood levels that are relevant to the business. Now, 27001 and 27005 do not state whether these levels should be quantitative or qualitative, high to low, 1 to 5, 1 to 100, or otherwise. What is important is that people understand the scoring in business terms. So I've put both ways up there, quantitative or qualitative. Some people like to use the qualitative because it gives you a rating of low, medium, or high, 1 to 5, using the chart we showed you earlier. Others like to use quantitative because you can put that risk in more, you can relate it more to your business terms. So you can say the loss of this laptop will cost us X amount a year, or in that case, if the office floods, it's going to cost us this much. So you can see in real time the actual financial cost to the business. But again, it's not always a financial cost to the business. It could be a reputational cost, anything like that. So when we think about our impact levels, as we said, you can split your impact levels down into certain levels. So we start off at the bottom, a minor, almost everyday business, and on the side there we can see that will cost us around between £0 to £1,000, and it goes up. A significant impact, it may change the organisation to change some processes, and it could cost anywhere up to the region of £10,000. Major is unacceptable. You may need to do some organisational change. Again, it costs in the region of £10,000 to £50,000. Intolerable, this is a significant organisational change needed. Potentially you might need some recovery from there as well, and again you can see the cost rising up there until we get to catastrophic, which could be a potential closure of business, upwards of £250,000. Now again, all these things here are just things I put together. You don't necessarily have to use these scales. These are just gives you an idea of what we mean by coming up with your impact level. So when we've conducted our risk assessment, we've got our risks, we know what our threats are, we know what our vulnerabilities, we want to treat the risk. Now we've got 4 options for treating risks. And of course, not all risks are created equal. You have to focus on the most important ones, so-called unacceptable risks. And like we said, there's 4 options to choose from, which are modify, transfer, avoid, and accept. Now, modify, this means to apply security controls, which can be taken from Annex A of 27001, which we'll talk about in a sec. These will help decrease the risk. We can transfer the risk to another party, such as an insurance company by buying an insurance policy for something, for example, or by outsourcing the risk to an IT company. We can avoid the risk by stopping an activity that is too risky or by doing it in a completely different fashion. And we can accept the risk. For instance, the cost for mitigating that risk may be higher than the damage done itself. So we might say, well, we'll accept that risk. Now, this is where you need to get creative. How to decrease a risk with minimum investment. It would be the easiest if your budget was unlimited, but that is never going to happen, right? And I must tell you that unfortunately your management is right. It is possible to achieve the same result with less money. You just need to figure out how it's done. So let's look at each one in turn then. So let's look at treat or modify. Now, this is a process used to ensure information risks are reduced to an acceptable level. Now, action should be in line with the level of risk posed to information assets, normally by adding, strengthening security controls that will reduce likelihood or vulnerability. Now, 27001 has a Annex A, which lists a lot of control measures. Now, Clause 6.13 in 27001 describes how an organisation can respond to risks with a risk treatment plan, which is an important part of choosing appropriate controls. Now, within Annex A of 27001, as we said, there's 114 controls and in 14 clauses and 55 control categories. Now, these are, as you can see on the screen there, so we've got A5, which is information and security policies. Now, these are controls on how the policies are written and reviewed. We've got A6, Organisation of Information Security. These are controls on how the responsibilities are assigned. It also includes controls for mobile devices and teleworking. A7 is Human Resources Security. This controls prior to employment, during and after the employment as well. So the controls around how we onboard people, how we train them, and how we offboard people. A8, asset management. These are controls related to inventory of assets and acceptable use, also for information classification and media handling. A9 is access control. This is controls for access, control policy, user access management, system application access control, and also user responsibilities. We then got A10, which is cryptography, which is the controls related to encryption and key management. A11 is physical environmental security, which defines secure areas, entry controls, protection against threats, equipment security, secure disposal, clear desk, clear screen policies, and so on. A12, operational security, looks at controls related to the management of IT production, change management, capacity management, malware, backup, logging, monitoring, installation, and also vulnerabilities. A13, communication security. This looks at network security, segregation, network services, transfer of information, and messaging. A14, system acquisition, development and maintenance, which is controls defining security requirements and security and development and support processes. A15, supplier relationships, which is controls on what to include in agreements and how to monitor the suppliers, so we make sure that our transactions between our suppliers is secure and there's security built in around that. A16 is information security incident management, which is quite a big section of Annex A, which is the controls for reporting events and weaknesses, defining responsibilities, response procedures, and collection of evidence. Now, this is quite an important clause, especially for things like reporting breaches to the ICO under GDPR and things like that. A16 clause is quite an important clause which focuses on there. A17, information security aspects of business continuity management. So this is about controls requiring a planning of business continuity. So it's procedures, verification and reviewing, and also IT redundancy. And lastly, A18 is compliance. So this is controls requiring identification of applicable laws, regulations, intellectual property protection, personal data protection, and also reviews of information security. Now, Annex A of 27001 sets out these 114 good practice security controls, and the controls use the word should and are neither mandatory nor exhaustive. This means that organizations with differing risks will apply these controls at different levels of strength. Now, although ISO 27001 doesn't require you to use Annex A controls exclusively, you do have to check the controls you select from elsewhere against those in Annex A to ensure that each risk is appropriately mitigated. So, having selected your controls, you need to produce a statement of applicability, or SOA. Now, this is one of the most important 27001 documents, and it should identify the controls you've selected to address the risks you've identified, explain why you've selected them, state whether or not they've been implemented, and also explain why any ISO 27001 Annex A controls have been omitted. As we said, you don't have to use the controls from Annex A, but you do have to make a note as to say why you've not used them. You have to justify your reasons not from using them. Now, there will be at least 114 entries in your statement of applicability, one for each Annex A controls, all of which will include extra information about each control and also ideally link to relevant documentation about each control's implementation. Now, a risk assessment report can be very long, okay? So if you look at all your risks and all the threats, all the vulnerabilities, and you have to risk assess each one, that risk report can be quite a lengthy document. So a statement of applicability is a quite a useful document for everyday operational use. It's a simple demonstration that controls have been implemented and a useful link to relevant policies, processes, and other documentation and systems that have been applied to treat each identified risk. Think of it more of an index to your ISMS. Now, this document actually shows the security profile of your company based on the results of the risk treatment. You need to list all the controls you've implemented, why you've implemented them, and also how. This document is also very important because normally when we come out an audit, it's one of the main guidelines for audits. It's quite an important document that we look at when we're actually conducting the audit. So that was treat. So let's look at share now, or transfer. So generally, by insuring or outsourcing, you can transfer a risk. You would typically still suffer the impact, but you can share the risk with someone better able to mitigate it, such as, like we said, an IT support company or insurance provider. Now, this shifts part of the risk to other organizations or contractually to business partners, as we said, for example, IT support services. However, as an organization, you can't transfer the ownership of the risk. At the end of the day, it's still your risk. It's just how you've dealt with it. The next one is avoid or terminate. Now, this means by ending the activity or circumstances causing a risk. So, for example, by not carrying out the activity or by moving locations. Now, this occurs when there is no cost-effective action to reduce the risk. And it may involve choosing an alternative action that meets business needs. You may still have to do it, but you have to do it a different way. Okay. And finally, accept or tolerate. So this is commonly an acceptance by management that risk falls within their previously established risk acceptance criteria or via extraordinary decisions. And it means that no additional action is required other than what is already in place. Now, this should be documented and communicated to senior management. So ideally, the risk owner, once you've identified a risk, would say, right, it's a high risk or medium risk, but we've got to accept it. We have to tolerate it. There must be somewhere on there where you must have it documented to say what the risk is, why it's been accepted, and then have the ownership. The risk owner should sign off to say, I accept this risk. So when we've assessed our risks, identified our risks, We've selected control measures from Annex A or from other means. We put together a risk treatment plan. Now, this is a step where you have to move from theory to practice. Now, let's be frank, all up to now, this whole risk management job was purely theoretical, but now it's time to show some concrete results. We have to put into practice what we say we're going to do. We have to put into practice those controls to mitigate the risks. Now, this is the purpose of the risk treatment plan, to define exactly who is going to implement each control, in which time frame, with which budget, etc. Now, you can call this document an implementation plan or action plan, but it's best to stick to the terminology used in 27001. Now, once you've written this document, it's crucial that you get management approval, because it will take considerable time and effort and money in some instances to implement all the controls that you have planned here, and without their commitment, you won't get any of these. Now, the thing is with a risk treatment plan is you identify your risk, you identify the controls that you're going to use to combat those risks. Now, some of them may happen overnight. Some of those will be easy to implement. Others may take months to implement. Some may require a level of infrastructure to be built in. Some may require additional training, for example. But as long as you have identified that within your risk treatment plan and you've documented that somewhere to say this is what we're doing to this risk, this is how we intend to fight this risk, then that's fine. The big issue I have when I go in and audit companies is they've identified a risk but done nothing about it. Now, that's not always the case. They may have done something about it, but there's nothing documented to say what they will do. If you've identified a risk and you're going to do something about it, as long as that process is in place, that's good to see. It's when risks have been identified and nothing's been done at all. Obviously, if it's a risk to the business, you need to address it. And this is it. You've started your journey from not knowing how to set up your information security all the way to having a very clear picture of what you need to implement. The point is, ISO 27001 forces you to make this journey in a systematic way. Now, that's it. We've touched on risk assessment and analysing risk treatment, and the Annex A control measures. Again, it's a guide. It's not a set rules to say this is how you should conduct your risk assessment. It's a guide to kind of get you in the right area and get you thinking about the right way to conducting it. Again, like I said, how you conduct the risk assessment is entirely up to you. It doesn't need to be anything like way we've described. You need to make it fit your business and fit for you. We've got a bit of time for questions now. As I said, if we can't get the answer to your question, please feel free to contact us and we'll get back to you with a frequently asked questions blog. Also, please do visit our newly refurbished website. There's additional content there, not only for 27001, but for all for many standards. So please feel free to visit the website as well. So we've got a question online from Barry. Hi, Barry. When completing a risk assessment, how much consideration should be given to something completely outside your control, such as an act of God or as a result of war? Yeah, no, good question. I get this quite a lot when auditing. The key is you've got to keep it reasonable, okay? That said, for example, I recently had an audit where on one of their risk assessments, they had plane crash into the building. Now, some of you may laugh at that, but this particular building was on a flight path, of a major UK runway. So, yeah, that is not a valid risk. If you're situated that close to an airport, yep, yeah, it does have the potential to happen. If you're nowhere near a runway, yeah, obviously that risk is lower. You've got to keep it reasonable, okay? Yeah, I meteorites hitting the building, no, come on. Keep it within reason. Again, like I said though, if you've got things like nuclear power plant down the road, yeah, you might want to put it in there, because if they have an evacuation, are you within that radius that you need to be evacuated? So, keep it within reason. So the statement of applicability and risk treatment plans are key documents. What do you use as a key driver optionally and in audits? I mean, really, when you look at the statement of applicability and risk treatment plans, yeah, look to see what the we're going to look to see what the company has identified as risks. So what I do is I look to see what they've identified as risks, look to see what they've implemented, what their controls are in their statement of applicability, and then while I'm auditing, you can get a feel to see if those actions have been implemented. You know, if they're saying we have a big risk, this is a big risk, right? Okay, so what are you doing about it? Are the controls you've adopted? Have you implemented them? And if they haven't been implemented, why not? However, like I said, if it's one of those things where it's going to take time to implement, as long as you stated that somewhere, you know, we can look at it differently. We've got one saying, should risk have open and closed status, or can they be ongoing if the threat vulnerability is recurring and needs ongoing attention? Well, I mean, yeah, the good thing with the risk assessment process is it's not just you do your risk assessment and that's it. You should be constantly reviewing your risk assessment process, because you know, risk can come from very different instances. If you have, for example, a breach or a cyber attack, for example, you might want to, through your non-conformity corrective action process, include that into your risk assessment, because that could be a new risk that you haven't thought about. Open and closed status. I'd like to think that all the risks that you've identified, you've come up with some kind of control measure. Like I said, the control measure implementing that may take some time. So yeah, like Tom said in a question there, it may be that you've not quite closed that risk out because you've got to implement a new process, or there's some building work needs doing. So yeah, I can see what you mean by that. As long as you've addressed the risk and you've said what you're going to do, you know, things don't happen overnight. So as long as you've got a kind of action plan, ongoing action plan is to say, this is what we're going to do. It's going to take us this long. I'm just reading through some more of the questions now. Thanks for these guys. Yes, so we've got a question here. What linkage is there between a risk assessment done for ISO 9001 and for 27001 here? It seems the basic risks to the business are the same. No, that's a good question. Yeah, so the good thing with the standards nowadays, and thanks to Annex SL, is that the standards are all aligned under Annex SL. So if you look at a new standard now, the main clauses are exactly the same. And yeah, in all the standards, it asks us to look at our risks. Risks and opportunities for 9001, information security risks for 27001. So I see this a lot where people have used the same process for risks for 9000 and 27001. But obviously for 9001, you're looking at different areas that you are looking for 27001, but it doesn't mean you can't do them all together. You know, one process that covers both quality risks and information security risks. I've seen that done quite a few times, Sam. And again, it's been done differently each time I've seen it. So how you kind of conduct that risk assessment is entirely up to yourself. One last quick one from Ryan. I know this is probably difficult to answer, but would there be a number of excluded controls that you would feel be excessive, e.g. out of 114 you've excluded 50 due to limited scope? Would an auditor find a number excluded as appropriate? What I find is with the Annex A controls is it's much easier to include a control than it is to exclude it. What you'll find is that you're already using one of the controls without knowing it. I do find that companies do struggle explaining why they're excluding it, because it always relates back to something else. So yeah, be careful. Obviously there are controls in there which relate to software development. So if you're a company that doesn't develop software, yeah, I can understand if you exclude those. But then again, they might relate to something else that you have outsourced or something like that. But yeah, be careful with excluding too many controls, because you've got to be able to justify justify why it's been excluded. And like I said, it's a lot easier to include them than it is to justify the excluding. But again, if you can justify that, then that's up to you. Like I said, it's how you implement the standard and the controls around risk assessments is entirely up to you. Okay, the question, no more questions on screen. However, like I said, if you listen back to this webinar, or you're listening to this webinar later on, if you're live now and you've come up with a question later on today, feel free to email into us and we'll put together a frequently asked questions blog. And what we'll do as well is we always update these webinars, so the next version of the webinar, which comes out next month, will include some of your questions into the content, so people who listen to it in the future won't need to ask that question. So thanks very much for the questions, thanks very much for listening, and hope to see you again soon. Thanks, bye bye.